Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. Hope you had an outstanding week and a great 4th of July.
Yes.
And thank you for taking the time to join us here on this program. If you're new to the show, it's not a headline show. You know, we did talk last week about the Brexit because so many people wanted to know, and you know how should you respond and how should you act, and it's going to continue to be a big deal, Sherry, for a long time. Yeah. More of this show is aimed at bigger, longer term decisions that, regardless of the day or the time of the year that we happen to be in, have the ability to really impact your portfolio. And as I promised last week, part of this was going to be dealing with understanding where you should live while you're working, where you should live when you're retiring, what we would call in the legal world domiciled, your state of residence. And we're going to talk a little bit about your portfolio and knowing the model that you're in, the business model that you are that you have subscribed to. There's a lot of stuff that goes on in the world of cybersecurity. We have discussed that before on the show, but I got a really blunt question. Joe, how do I know my stuff
is okay?
Is protected? How do I know my stuff is okay?
Yeah, well,
and it's a great question. So we're gonna go ahead and address that. One of the things that I started doing as I quit teaching at Purdue, I gave up my professorship there, the adjunct professorship. And spent more time teaching planners how to plan. One of the things I started doing was writing for Investopedia. And so Sherry and I are going to go through a bunch of the questions that I worked on last week and just try to give you some things, some quick ideas and thoughts as opposed to longer term big concepts. So that'll be the brunt of this show. If you got a question or comment, you can always shoot us an email. Consider this at yourlifeafterwork.com. We'll take a break and we'll get right back at it.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
So happy to have you along. Sherry, have you always been a Hoosier?
No, I was born in Michigan.
Born in Michigan.
Yep.
And I was born in Muncie, where you live, and moved up by Lafayette for a few years, and down in Bloomington, and but the rest of my life has been here in good old Anderson.
You are a Hoosier.
I have been a Hoosier boy forever.
Wow.
And take that very very personally. We have clients in 25 states. I could live anywhere I want to live. I like good old Indiana. A friend of mine, Jim Alt, said the only other person that he knows that intentionally moved to Anderson. The difference is I didn't leave from being in charge of France GM France. So.
Right. Yeah. Seriously.
But anyhow, it's here. So the reason I'm bringing this up, I get asked the question a lot less than I probably should get asked. Because people do things without understanding how they're all unified and connected in one thought. So, that fiduciary focus that I always talk about, those 4 things that you have to pay attention to: risk and volatility, fees and expenses, taxes today and tomorrow, and real return. That's what should be on your dashboard and the heart of every conversation that you make financially, especially about investing. Where you live has a lot to do with what you do while you're working. Your job can dictate where you have to live. My brother, much to my chagrin, took my nieces and nephews and loaded up the truck and headed off to Ohio. And so they're officially there now. I realize it's not that far, but it's just the idea.
It's not that
he's no
far.
longer a Hoosier. And, I looked at him. I said, Jonathan Gerald, what are you thinking here? And he said, you got to go to where the job is. And, when you're working, that may very well be true. When you're retired, that is not the case. Now, I will tell you, in all the years that I've done this, 28 years worth of this now, the one thing that controls where people go the most, I think if I ask you, Sherry, where it would be, most people would always say the weather. It's not. It's the grandkids.
I was going to say, no, I wouldn't say that. It would be my kids.
I've seen many more people move because of their grandkids than to move because of the weather.
Oh, yeah.
Right? Now, number 3 ought to be on that list, the tax situation. And, this is very, very important to me, paying attention to the tax stuff in terms of where you're going. And it's, I want to point out again, the average life expectancy of 2 people who make it to age 60, right? So husband and wife make it to age 60. The actuaries tell us you have a 90% probability of one of you making it to 90. That is 30 years.
Right.
So, I've been in Anderson for 28 years. We've been in the same house, I think, almost for 20 years. I think it's 19 years this year, 18 or 19 years this year. Don't forecast leaving my house.
Yeah.
But I can tell you, I don't forecast owning another house in other places unless it's for a tax benefit. You can visit.
Right. Yeah.
You can visit we've got clients every year that go to the same place in Florida, that they're there for a month, some that are there for 3 months, but they don't own it. Because when you look at 30 years of retirement, you can't look at that all as one segment, right? You're going to go through a period of time where you've got plenty of energy and you want to travel. You're going to go through a period of time where you want to be closer to the grandkids and the doctor and the comfy couch.
Yeah.
And you're going to be one period of time where you aren't able to do a lot
of anything.
It's usually dictated by your energy level and the medical situation that you're in.
Right.
And so, buying a piece of property and then having to dispose of it, the ownership just tends to get overrated when you think about that.
Yeah.
But from a tax standpoint, this is different. Now, one of the questions that I get before I go into this is, Joe, do I have to own a place to be domiciled there? And the answer is no. Now, your domicile is where you spend 6 months
of
and
your
1 day
life.
of your life each and every year. So we have had a lot of people over the years who have moved to Florida, for instance, because of the weather, right?
Right.
Florida has no state income tax, which if you're in Indiana, that's around 5%.
Yeah.
Right. So now think about this from a tax implication. Either you've got, $1,000 a month worth of income that's coming in, and moving to Florida would save you, $50, right? Just one of those things. Yeah, if it's out of every $1,000, right?
Right. Yeah.
Out of every $100, it's going to save you $5.
Right.
Right. So it may be something to be able to consider, if you're down there for 6 months in a day, but you do not have to own property in Florida. You merely have to be there. And so some people actually do rent. They're there for 6 months in a day. You can go get a library card, where your voting is and all of that. You're no different as a retiree than you were a young person when you started out.
And you rented a place.
And you rented a place.
Right.
It would be discrimination to be any other way.
Right.
So keep that in mind. If you are moving, please keep in mind that if you have a will, you need to have your will redone for the state that you live in, right? So go get an attorney and get it updated if you make that move. On the other hand, if you have a trust, the trust is actually fine. That if you had a trust that was written while you were a resident of Indiana, and then you moved to Florida, you can do that, and your trust is still just fine. So how do you come up with where the best is and where the worst is?
How do you?
In this case, they did it off of a host of about 5 or 6 things.
Okay.
Based off of taxes was their number one choice, right? So we're looking at it from the tax.
Okay.
Living expenses is number 2.
That makes sense.
Number 3 is banking rates.
Oh.
What it costs to be able to access capital and get to it.
I didn't think that.
4th is health insurance cost, does vary greatly. And last but not least are Social Security payments, which I don't see differ that much depending on where you are, but I suppose they could.
Okay.
Right? So the article is put together. I want to give credit where credit is due. Came out of the 401k Specialist. And it was, let's see, well, they gave us the determination for where it came from, so we'll just stick with that.
Okay.
All right. The 10 best states for retiring rich. Number 1, Delaware. Now, again, this is somebody who's wealthy.
Yeah.
Right?
Okay.
Who wants to retire someplace and protect their money. Number 2.
Protect their money.
Number
okay.
2 is where you came from, Michigan.
Yeah.
Number 3, good old Indiana.
Whoa.
4, Maryland. 5, Florida. 6, Jersey. 7, Pennsylvania. 8, Mississippi. 9, Ohio. And 10, Georgia.
I'm surprised Indiana's number 3.
I'm not surprised at all. I mean, we're in a very wonderful place to live.
Wow.
Low cost of living.
Well, that's true. Yeah.
You've got so living expenses are there. The tax rate is low relative to other places.
Is it?
Yeah, very much so.
Huh.
So the 10 worst places for retiring rich. Number 1, Hawaii. Number 2, Vermont. 3, North Dakota. 4, Montana.
Wow.
5, New Mexico. 6, Alaska. 7, Colorado. 8, West Virginia. Heart and prayers go out to the people there with all of the weather that's going on around the Greenbrier. 9, Maine. And number 10 would be Nebraska.
I am shocked by that.
I'm surprised that you're shocked. Which part are you shocked about?
Well, I know a lot of retirees that go to Montana, out west. Maybe I'm thinking Wyoming, but I know some that go to Montana.
Sure.
And I think they go there primarily to do outdoor sports, but
Right.
still, I mean...
So there are different, that's what I'm saying. There are different things that dictate where you go.
Yeah.
That's what, if I were a retiree and was going to leave Anderson,
Yeah.
I would visit the places that I wanted to visit, and I
Right.
would live where I wanted to live based on the right tax situation.
Okay.
So, for instance, let's say you own a company and you're going to sell a company, and a lot of taxes are going to come in, but when that sale is going to transpire. Why wouldn't you move to a state for a year that has no income tax?
For when you get all that money.
When you get all of the money, when you actually get receipt of it and the purchase price.
And then you can move again if you wanted.
And then you can move. There's nothing that says you couldn't move again. We've had people move to Florida and come back, usually not over a 1-year period of time, but we've had people who have done that and realized that, that they wanted to stay here, or they sold their property down there. If you leave Indiana to go to Florida, you lose that homestead exemption. Which is a big break. And if your income's not high, it may not make sense to actually go to live in Florida. Article pointed out a few other really key things, I think. The 10 best states to retire rich all lie east of the Mississippi River. Even with the lowest property tax in the nation, Hawaii ranks as the worst state to retire rich due to extremely high average income listing price and cost of living index.
Well,
Right.
yeah.
So again, depends on
Cost of living.
where that's right, where you're at. Alaska's average health insurance premiums top the most expensive list at a whopping $719. And 7 of the 10 worst states to retire rich are located in the West and Midwest.
That's interesting.
And western states, here you go, Montana, Oregon, and New Mexico spend an average of $3,733 less on Medicare for their citizens per year than eastern states like Jersey, Maryland, and Connecticut. And that's because the people who go out there are healthier, wanting to be active.
Yeah.
They're wanting to be active. So,
That's why they're there.
it does matter. One of the things when you see your attorney, if you're working on a trust, that I would strongly encourage you to talk to him about is what's called a situs provision. It allows the trust protector. I cannot be a trustee of people's trust, but we are trust protectors of a lot of trusts. which gives us the ability to restate what state the trust is a resident of, if you will. I mean, it really has its own place, like an Indiana trust is an Indiana trust. Well, what if the tax code changed in Indiana negatively or was better in another state? A CITES provision would allow your trust protector, whomever that be, to give the ability to actually change the state that the trust was prepared in, or not prepared in, but maintained in. Just from a tax standpoint going forward. A lot of stuff out there to think about and to ponder. If you've got questions or comments, you can always shoot us an email. Consider this at yourlifeafterwork.com. Don't forget, if you want more, if there's other questions that you have or other parts of the show, you can go to our website at yourlifeafterwork.com. You can pull up our newspaper article, find our other shows that we've had on there. And don't forget, if you're interested in the market, that's probably the most common question I get is, Joe, why don't you talk about the stock market more? We do that in a weekly video that's very timely that comes out on Thursdays called The Market Carver. It's a 3 to 5 minute video that either I do or our chief investment strategist, Adam Harder, does. More than willing to let you have that. It's a freebie. If you're a family that we take care of, it's much more in depth. But we send out one that gives you some ideas as individuals as well.
Comes right to your inbox.
Comes right to your inbox. Just sign up at Consider This at the website at yourlifeafterwork.com for The Market Carver. We got to take a break, but we'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. Well, each and every week we send out the opportunity for you folks to send in questions. It usually provides a question with a little bit of detail. And so Sherry is going to play our Vanna White.
I'm Vanna today.
She's going to read the question and give us a little bit of detail. And then I'm going to make her answer it.
No, I was going to say, here's the deal. I have the question. You have the answer.
We'll flip a coin.
No. Okay. All right.
Go ahead.
So the first one doesn't really have a lot of detail, but the question is, I am contributing to a 401k at work. How much can I contribute to a traditional IRA?
And they don't give us any other data?
No other data.
All right. So here's the deal. Your 401k is your retirement plan. When you hear the word 401k, it means you're working for a place for profit. If you had a 403b, it would be a place that's a not-for-profit,
right.
A hospital, school, something of that nature. So 401k is a Department of Labor company retirement plan that your employer may be putting money into or may not, but you are contributing to it or may not. And it's growing either tax deferred or you can have a Roth option if your plan allows for it so that you pay the taxes today but let it grow free and clear.
Right.
It has nothing to do with you having a Roth IRA at all, Sherry. So you can have a Roth, you can have a 401k at work.
And your own IRA.
Be a Roth or not a Roth. You can have a 401k at work if you're under 50, is provided you have this much income.
Right.
If you're under 50, you can put in $18,000 a year. If you're over 50, you can put in $23,000 a year. Okay. In an IRA, there's really 3 of them that exist. You could have a non-deductible IRA, meaning you made too much money to qualify. You can have a traditional IRA where you are able to put it in and get a deduction. Or you could have a Roth IRA where you paid the taxes today, but the money would grow free and clear forever. The total amount that you can put in is, if in those 3 plans, if you're under 50, is $5,500 a year, and $6,500 if you're over 50. Right? Now, each of them have their own rules. So in this case, the question is, if I put money in my 401k, am I eligible to contribute to a traditional IRA?
Right.
The answer would be yes, as long as you're under 70 and a half. So you're not having to take required minimum distributions. And it would be yes, provided you had earned income. And remember, you can do it for your spouse as well. Now, the catch here is going to be whether it's able to be deducted or not. And if you have a pension plan that you're available to participate in at work, right, a 401k, you don't have to contribute to it. But if you're eligible for it, then your income is very restricted on how much you can make and still qualify to put money in a traditional IRA that is deductible. So the number kind of varies a little bit year by year, but let's just say if your AGI is more than 70,000 and change, that's between husband and wife, you're probably ineligible for the deductible IRA, though you could still put money in the non-deductible. Keep in mind, it has nothing to do with whether or not you can put money in a Roth. Right, the Roth IRA is only limited by you have to have earned income. That's on line 7 of your tax return, and your adjusted gross income being less than $184,000 if you're married filing jointly.
Wow.
This
is very complicated. I'm just saying. I think it's very complicated.
This is easy.
All right,
Easy
next.
peasy.
Next question. This is an interesting question. Does every average person have to pay Social Security tax and file taxes? Now, that's the question. Does every average person, define average, but does every average person have to pay Social Security tax and file taxes? And the information is, I know someone who's in their 70s and has not paid Social Security tax or filed taxes since they retired. They have no other income. Is it mandatory?
Okay, so you do not have to file taxes if you do not owe. Okay. So with Social Security income, if you look at your tax return, it is about 60% down the page, maybe 70% down the page. There's a column for you to put the amount of Social Security benefit you received in the middle, and then off to the right in the ledger is the amount of income that is taxable. Right?
Okay.
So the maximum amount under current law that your Social Security can be taxed is 85%. That's the maximum amount of the contribution or the money that you get that is taxable.
Okay.
And it's based on the amount of other income that you have.
Okay.
So if somebody was having some income tax withheld from their Social Security, so they were automatically paying into it, or automatically paying taxes, and that was more than enough to cover what they would have owed, or they would have been entitled to a refund even perhaps, then no, they don't have to file. Right?
Okay.
They could be wasting money very easily. Right? Now, where we get into this conversation and question, though, does the average American pay taxes? Anybody who has earned income on line 7 of their tax return, and there's other places that you can get it as well, all pay into Social Security while they're working. That's the money that goes to what we call FICA.
Right. Yeah.
That's 7.65% of everything that you make.
Yeah.
That comes out of your check. And then your employer matches the other half. If you're fortunate enough to be self-employed, like we are, you get to pay both sides at 15.3%.
Jeez.
The other part of the tax is the marginal bracket. And that's the one where you, if you think stair steps start to go up.
Yep.
And the average American does not have anything on this. It's 54% of Americans don't pay any taxes on the marginal side.
Yeah.
But 100% of Americans pay taxes on earned income.
Right. Okay.
So there you go.
All right. So here's another IRA question. Can I contribute $6,500 to my Roth IRA and another $6,500 to my traditional IRA in the same year of 2015? I am 59 years old.
59 years old has nothing to do with it other than because he's under 70 and a half.
Right. Yeah.
Can you contribute money to a Roth, Sherry, if you're under 70 and a half?
Yes.
Yes, you can. As long as you have earned income on line 7 and your AGI is not too high, then you can contribute to a Roth IRA as long as you go.
Right.
You cannot contribute to a traditional IRA if you're over 70 and a half. Cannot happen, cannot do it.
But he's 59.
And he's 59. And so he asked the question, can I put $6,500 into both the traditional IRA and a Roth IRA? And Sherry, your answer for him is?
Yes. No. Yes.
Why? Which is it? Come on.
Oh, let me think. $6,500.
The first.
I know you can do one.
The first question I would ask, right? So your checklist. We're very
earned
checklist driven
income.
Here at the Financial Enhancement Group.
Right.
Are you under 70 and a half?
Yes.
Do you have earned income?
Yes.
Is it $13,000 or greater? We'll assume that the answer is yes.
Yes.
Are you married? Yes. Is your spouse contributing to anything? No. Then yes, sir, you could put in $6,500.
Wow, we don't know all that stuff, though.
I'm telling you, I'm giving you a hit.
All right.
If he was married,
right,
then he could put in $6,500 in one of the IRAs for him and $6,500 in the other IRA for her. Your limitation to IRA contributions in any given year per individual is $6,500.
That's what I was going to say.
So he could do half and half, right? He could
If
do
he's
30,
married.
He could do 3,300 or whatever it is, in 3,250 in each one of them, in a traditional and in a Roth.
Right.
But his total cannot be more than 6,500. But if he's
Right.
married, he could also do the same thing for his spouse.
So if he's single, no.
If he is single, the answer is no.
No.
Nada.
Okay. Do I still have to pay Social Security tax on my 2015 earnings? Okay, here's the detail. I retired in 2014, started my own business in February of 2015, made about $1,500 in revenue in 15, but had a net loss due to startup costs.
It depends on how the tax person is putting it together. The way Social Security income works, when you have, or the way that would work on a tax return, is he may have had revenue, but it wasn't necessarily earned income. If he filled out a W-2 and was for himself,
Right.
as an employee, then the answer is he's crazy. But if it was set up properly and it was startup cost and that was just the revenue, then there should be no Social Security tax that is paid as long as he reports it correctly.
Right. Okay.
Remember, that's why people say, Joe, are you a tax preparer? Absolutely not. I am a tax planner.
Right.
We do all the planning. I use great CPAs that actually put my stuff together on the 1040. And send in the story to the IRS. We work with a lot of very competent CPA firms, and it's important to have that.
Okay. Question: how are life insurance proceeds taxed?
This is a really good question.
I like this question
and
too.
a strong one. Life insurance is now and always will be one of the greatest resources for tax-free income. So life insurance premiums are not deductible. However, the benefit is tax-free. So if I've got $1 million life insurance policy on me and $1 million comes to fruition, I die, Barb gets a check for $1 million and has to pay zero income tax on it. That is a beautiful thing.
Yeah, that's really great.
Now, there's this one minor little...
Of course.
Yeah, there's a problem. There's a twist here.
Okay.
People are living longer. It's not that really that we're living longer. It's just more of us are living there. And so most of us can easily identify somebody who's in their 90s, 95, 96 years old.
Yep.
A lot of the old life insurance policies, and you really need to be aware of this, a lot of the old life insurance policies that are out there mature when you turn either 95 or 100. So imagine being 100 years old and all of a sudden getting that check in the mail for $1 million. Your life insurance policy, the insurance agents would say, is paid up, right?
Right, yeah.
The insurance company is going to send you a check for $1 million. And it is very taxable because you are not dead. You are still a living, breathing individual. And that could be a huge wallop. Now, one of a tragic situation that happened for a lady that her son-in-law got mad at her insurance agent. It's almost always the outlaw. The son-in-law got mad at the insurance agent, went to a bank, and the broker at J.P. Morgan that was sitting at the desk told him that and agreed with the son that the mom should surrender her life insurance policy.
Wow.
And, so the daughter, not necessarily agreeing with the broker, comes to me and says, Joe, what do I need to know here? What am I thinking? Well, here's your checklist. You need to know the amount of money that was contributed, all of the years, all the premiums that went in. That's your basis. Remember, because there's no deduction for life insurance. So that's your basis. Secondly, you need to know if there is a loan on this policy and if anything has been paid back on the loan or how much interest there is. Sure enough, in this case, the lady had taken out about a $400,000 loan. Wasn't $400,000 that she got. It was the amount of money she withdrew plus all of the interest that had accrued on that.
Wow.
And so she had a policy that said it was worth about $200,000 if she died. Right. The loan, by the way, is forgiven at that point in time from a tax standpoint.
Oh, wow.
But she had $400,000 worth of debt that was on there. So sure enough, the son-in-law surrendered the policy with the banker at J.P. Morgan. They surrendered the policy. She got a check for $180,000, right? But she got a 1099 for almost $600,000.
It said she owed that much.
That said that was the amount of money that had left.
Oh,
Her
yeah.
basis in the whole thing was $250,000.
Yeah.
So she had to pay taxes on $350,000 in 1 year and ended up having to declare bankruptcy because she didn't have the income, and there's nothing that the IRS can do to pass on that. I mean, it doesn't matter. It was a sad story. It didn't matter. The bank did it. It didn't matter that the son-in-law was involved. It's done. The cat is out of the bag. The 1099 is out. And she ended up having to declare bankruptcy because people don't know the rules and don't pay attention to the details. Hey, you're listening to Consider This. I'm Joe Clark along with Sherry Contos. I got to take a break. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
And we are honored that you are around with us. Today we are playing a little bit of Q&A, questions and answers. I'm asking the questions. Sherry's providing you the answers.
Absolutely not.
Oh, come on.
Absolutely not.
You know,
Other way around.
Some of the modeling that is done when I taught at Purdue over this stuff is from these very basic questions and comments that people have. I do write for Investopedia as well as a few other places where people can write in and ask questions. If you got a question you'd like to hear on the show, I'm more than happy to answer it. It's consider this at yourlifeafterwork.com. I changed the names to protect the innocent,
yes.
But we'll have the question on the show, and I will respond to your question as well so that you get your answer. So go ahead, Sherry.
Okay, here's the question. Do we qualify for a Roth IRA account? Now here are the details. My total household income is about $110,000 a year. I am the only one that works. My spouse is a stay-at-home mom.
Okay, so stop. We know that they're married filing jointly is what we're going to presume.
Yes.
Because they are married.
Yeah.
110,000 is less than 184.
Right.
And so far your AGI is not too high, and he made 110,000, so he's got 110,000 of earned income on line 7.
So
right, keep going.
That's it. I heard that there's a limit on qualifying is what there are, but
there are limits, and understand with the Roth there are two very, very, very important words. One is a contribution. That is the amount of money that you put in this year. Mm-hmm. So in his case, Sherry, how much could he put into Roth IRAs?
$6,500.
And
$6,500
for
one for her, one for him.
There you go. You can contribute to one. Even the fact that she stayed at home.
Well, we're assuming
no longer matters.
I mean, we're just assuming he didn't tell us his age, but we are. I mean,
Roth, it doesn't matter. There is no age. It's only earned income.
Okay.
It's only earned income.
Okay.
So because there's no required minimum distributions that come from a Roth.
Okay.
So if he was over 70 and a half, he could not contribute to a traditional
IRA, but
right?
but a Roth's
and his income probably would prohibit him from being able to do that if he had a 401k plan available at work.
Right. Okay.
But in this case, he can clearly put money into the Roth, both for he and for her, on the contribution. Now, the conversion, and the conversion is when you actually take money that's already in an IRA or a 401k, and you convert it to a Roth IRA.
And when you say convert it, basically what you're saying is I'm going to go ahead and pay the taxes.
Yep, that's what it means.
And then keep it in that Roth until I decide to be done, and then I don't have to pay taxes on the growth.
That's correct.
Okay.
And there are no required minimum distributions that are required inside of a Roth. So many times when the thing that retirees get very furious over is things that make their Social Security more taxable, right?
Yeah.
Their Medicare Part B premiums higher. They get furiosio, right?
Right. Sure. Yeah.
And it's a frustrating thing. You won't hear the word issued by people who deal with retirees entitlement at all, because my clients will look at you and go, Joe, I paid into that thing for 40 years. It's not an entitlement. Mm-mm. I'm owed.
Yeah.
It's kind of like, okay, let's change the vocabulary in terms of how this works. But when you are 70 and a half And I've got 84-year-olds that fly themselves around an airplane. So
right, yeah.
70 is just not that old anymore. And when your Social Security check comes and you've got to pay more taxes on it simply because you had to start taking money out of an IRA or a 401k under required minimum distributions, it is people aren't so happy.
Right.
They're just not pleased with that.
Makes sense.
And so doing some of those conversions along the way just do make good common sense.
Okay, next question. What is the best way to fund my pre-retirement years? And here's the detail. I'm trying to postpone taking Social Security until the age of 65, 66 in order to maximize the amount I'll get every month. I am 61 years old and currently ... So that's all I have is I'm 61 years old.
Okay. So over 61 means that you're over 59 and a half.
Right.
There are two important numbers for pre-retirement, and when she means or he means pre-retirement, whichever it is, he means before he's going to quit work.
Yeah.
He needs an income source, but he doesn't want to sign up for Social Security yet.
Right.
All right. So let's break these into three areas. Should he or should he not delay Social Security? And the answer is, assuming you're in good health.
Yeah.
You always wanted to delay.
Right.
Each year that you take Social Security early, you lose 8% of your income, right? But it's 8% plus cost of living allowances that are going to come over the future years. So the one of the things that I show in the workshop with that I do at Community Hospital is we talk about Albert Einstein and compound interest. People don't understand how compound interest really works. So the example I show them is if you had $1 and you earned 7% a year, at the end of a year, you have $1.07.
Right.
Right, because of the 7%. At the end of 10 years, however, you do not have $1.70.
Right.
You have $1.97 because the 7 cents also
Always
compounded as well as they went in and grew. And so that just as compound interest works that way in your benefit, it works against you in Social Security when you pull the money out earlier.
Right. Yeah.
You're
Yeah.
not getting you've lost the 8% plus those cost of living allowances that continue to grow on side of the money. So I would encourage somebody that age to delay as well. Now, secondly, they said they were 61. So are they over 59 and a half? And believe me, my friends, the half matters. And the answer is yeah, they're over 59 and a half. So what does that tell us? You can get money out of an IRA without paying the 10% penalty. Now, it's still fully taxable.
Right. A traditional
IRA, but you can delay. You don't have to pay the federal penalty because you're over 59 and a half. The other number to keep in mind is 55. And if you happen to have money in a 401k, not an IRA, but in a 401k, and you're over 55, and you retire without the intent of going to make a lot of income somewhere else, I mean, you really are going to take up retirement or do something, you can actually get money without the 10% penalty out of your 401k at 55 and older. Right. So, again, IRAs and 401ks are different creatures.
Yeah.
But you have to know the rules every now and then. And this is one of the reasons why fiduciary matters so much to me. It's happened already once this year. Somebody retired at 58 years old. The broker moved all of their money from a 401k into an IRA annuity. Right. So it's no longer in 401k status.
Yeah.
It's now an annuity. So the broker got to make his 7 to 10% commission.
Wow.
The client needs money out. He's 58. Right?
Can't
get money out because he's not 59 and a half.
Right.
So the only thing that he could do was called a 72T, which I would encourage no one to do, especially on your own. But 72T, and if you miss one word in the sentence, Sherry, you're in trouble. But a 72T is a substantially equal periodic payment unchanged for the greater of 5 years or 59 and a half. So he's 58 years old.
Yeah.
So the only resource he had was to be able to use a 72T to start to take income, had to pay some surrender penalties on the insurance product that the broker had sold him, but was able to start taking monthly income from that, but has to go for the greater of 5 years or 59 and a half, correct?
Yes.
Yes. So at the end of 5 years, he's going to be 63 before he can stop taking that. If he were to happen to go back to work or do anything else, he is still obligated to take that money. I encouraged him, because of that and not knowing what his future was, to actually take a partial surrender and pay the 10% penalty as opposed to commit to being the 5 years. And in his case, he said he knew he wasn't going to go back to work, and he hates the IRS and wasn't paying 10%.
Yeah.
So I got it. I understood that. My job is just to provide the guidance there to the best way as we possibly can.
Yeah.
But be careful what you do when you get ready to go into retirement. And make sure that you're working with somebody that is a fiduciary that understands the tax code very, very well, because there's nothing that will separate you from the IRS or from your retirement like the IRS.
Yes.
Right.
Okay, last question. I want to start buying stocks. Where do I start?
That's very easy to do. It's not always the most promising, but it's all
Yeah.
Buying stocks are no problem anymore. You can buy at tons of online places. We keep all of our money at TD Ameritrade, but we're on the institutional side. You can open up an account at a TD Ameritrade in the retail side, Charlie Schwab, Scottrade, tons of places where
and just do it yourself.
You open up an account, you deposit money, you pick out what stock you want to buy. I would strongly encourage you to use exchange traded funds more than individual equities until you get up and going. That way you can buy a basket of stocks without a lot of fees and expenses, and you know exactly what it is that you own. It's a really, really good question, but I would probably go in that direction and use one of the discount brokers. Now, for all three of these conversations, I want to give out one last little disclaimer and warning, especially on the Roth conversions, because this is the one that even my top students at Purdue would get in trouble over. Roths came into being in the late 1990s. 1998, 97, they told us we'd have it. 98, we did. They became eligible for 401ks, 2002, 2003 era. But there was always a restriction on the amount of Roth money that you could convert.
Right.
Your AGI had to be below $100,000, including the amount of the conversion. Well, in 2007, they told us in 2010 they were going to remove that restriction. So if you go to look up Roth conversions, most of the data that you're going to see still has the AGI restriction, because Google is not date sensitive. It is data sensitive.
Yeah, right.
And the majority of the searches were done before these changes come into place. And so people often say, hey, well, I can't convert. I make too much money. Whoa. Has nothing to do with age, has nothing to do with income. The only thing it has to do with is, do you have enough dollars to be able to pay the taxes? And with one of the strategies that we've been able to use in here, we've been able to create millions of dollars of tax-free money just by understanding the tax code for people and maximizing what goes on your 1040 every year. So by being able to sit down and come up with a strategy, it's not an all or nothing deal that you have to do every year. You want to figure out what is the max amount of money that I can afford to pay taxes on right now, and where does that source of money come from? It should never come out of an IRA, by the way, or the Roth to pay the taxes. That never makes sense. So how much cash flow do I have to pay the taxes? Based on the tax bracket that I'm in on my 1040, my marginal bracket, what is the appropriate amount to be able to pull out to maximize my individual situation or scenario? That's why I always tell people, if you're going to email me a question, a tax question, I need to know what's on line 7, your AGI, and line 43. If you give me those three, most of the time I can help you reach a good decision about what should go on in your life. But just be careful Googling and trying to get data. You can get yourself hurt pretty quickly. I heard the other day on the Medical Association says 30% of self-diagnosis off of WebMD are accurate. That means 70% are not.
Right. Wow.
Right? The deal is, with being sick, you figure out real quickly if you got it right or wrong.
Yes,
right?
yeah.
With your retirement, you're not going to figure out so quickly. So people do things, and then sometimes years later, we have to try to unwind them or sort them out. Hey, you're listening to Consider This. I'm Joe Clark along with Sherry Contos. Got to take a break, but we'll be right back. Don't forget to email me, though. Consider this at yourlifeafterwork.com.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. If you are new to the show, I may say some things that are pretty interesting to you. It's, you know, I've done this show for a long time, and I'm a certified financial planner by trade, and this is my 28th year in the industry. And so when I begin most of my talks, when I'm teaching at churches or at hospitals or whatever, when I do workshops for people to help them understand their retirement programs, I would say you're going to hear me talk out of three different sides of my mouth. As an adjunct assistant professor at Purdue University for 7 years, I talk a little bit academically about what we believe. And anytime you talk to an academic, remember, we're always talking in the term of large numbers. So we're not looking at Sherry Contos' life. We're looking at all of the Sherrys of the certain sector or certain area, a lot of people. And the rules that impact a lot of us are different than the rules that impact one or two of us. You have to look at your own life, understand that you are unique. So I don't discourage people from reading white papers and research. I think those are much more valuable than books if you can find a good one that has been peer reviewed.
More current, for sure.
They're more current, and the key thing is to make sure that they've been peer reviewed and that they're in the right thing. But then you have to break that down to your individual life. You can't just take some of the things that we say academically and apply them. All right. Secondly, I talk as a certified financial planner, meaning that I've been educated via the industry thoughts about ways that we should apply those things to your individual life, and go forward. And I'm a CFP and have been for since the mid 1990s, so for a long time. And that's what I taught at Purdue. So I'm very thankful to be a certified financial planner, and I appreciate it. But there's some things that, quite frankly, now that I look out on my career 28 years later, that I would have challenged if I was starting in the industry today, knowing what I know now.
Really?
So that third part of it that you're going to get is really that 28 years worth of experience that says, hey, this is horse poo, right? This works great on paper, but this makes no sense for your individual life or perspective. Yeah. And that's really how we have to boil it down. And so in my career, let's just look at the late 1990s, right? Don Hodson and I founded the Financial Enhancement Group, and we saw a lot of people, and we sent the money off to be managed in other places, right? And so I would sit down with people, and we would do what I knew as financial planning back then, which was almost entirely retirement and a little bit of estate planning. That's really all that I knew. And bottom line is, Sherry, you don't know what you don't know. Right. That's all I knew. And so we sent the money off to other places, and then the tech wreck hit. And I recognized and realized very quickly we couldn't do any worse if we were managing it internally.
Yourself, yeah.
And I became fascinated with the market, and we started managing money internally. And so my interest kind of moved away from the retirement side and the estate planning side, and went, and certainly not on the tax side, it went directly toward how does money need to be managed and treated, et cetera. Well, the people that you work with, like you and trust you, or they wouldn't be with you. Sure. Right. And the bottom line is, I wasn't focusing on things that they needed to be focused on, and so they didn't focus on them. So for 5 or 6 years we went by where my focus was managing the money more than helping them manage their individual lives, and doing
like the full life plan. Is that what you're talking about?
Doing what we call the 5 critical elements.
Right.
So, yeah. Fortunately, we, as we grew, Adam Harder is our chief investment strategist and is a CFA, and he works inside with us. Andrew Thrasher is a chartered market technician. So the three of us are able to run the portfolio. I'm not in the day-to-day operation of that as much because I do the planning part and the teaching part. And so now we can focus on those 5 critical elements that matter so much in your life. And folks, if you're not paying attention to them, it doesn't mean they can't hurt you.
Yeah.
They still
it's
matter.
Not benign. It's not benign.
This is not a net zero game. It's not.
Right.
It does matter. So we always start in every family update that we do with yourlifeafterwork.com. Make sure that everything is either on gear for your retirement in the future or your retirement today. Many of the people who come to see us are either 2 years before retirement or 2 years after they've started it and realized they needed some help.
Yeah.
And we have a lot of people who did it on their own for years and years and years and are just ready to enjoy life
and not worry about it.
With the Brexit and everything else, life's just a little more complicated.
Yeah.
So you start with your life after work. The second is a tax plan. I go over your 1040 line by line, to make sure that there's nothing that we could be doing from an investment side
that would help.
that is more proactive or smarter. So we work with people in their itemized deductions, their qualified charitable contributions, make sure that we can maximize the bracket that they're in, especially so the RMDs later on required distributions don't create a huge problem for them. That's something that we do every single year to optimize. We send out a letter about the middle half of October to say, hey, don't forget, make sure I've got your most recent 1040 up to on my system, and if there's anything changed in your year, that I need to know about. For instance, we have people who live on their Social Security income and have $1 million in an account. Right? It doesn't take a lot to live in Anderson, Indiana.
Right. Okay? Yeah.
And so in one particular case, she fell and broke a hip, and nobody thinks to call Joe.
Oh,
right?
Wow.
I mean, it's the kids didn't know that they should call me to tell me that.
Yeah.
We didn't get any. Our normal correspondence to her went just fine.
Yeah.
But she was somewhere else for 3 months and had a huge medical bill.
Oh, wow.
For paying for the help and the care.
So what would you have done if you'd known?
Well, the $1 million is sitting in an IRA. It's fully taxable, but
Right.
she had a $65,000 itemized deduction for the healthcare cost. So we could have pulled out $65,000 out of her IRA virtually for free.
Oh.
So we would be able to put it to an account where it had already been taxed, so that when the kids inherited the money, she's not going to spend it, but when the kids inherited the money, it would have saved them $15,000 to $20,000 in tax, because they let us know. So you do have to, tax planning has to occur before December 31st. Bottom line, it's not when you go to see your CPA.
Right. Yeah.
There's lots of situations where we get into the heat of it, trying to figure out what the best plan when you know the situation that you're actually in. The second one, or the third one rather, is the investment playbook, making sure that your investments match correctly for where we are in the world today. That's where that fiduciary focus comes into play, right? The risk and volatility, fees and expenses. A lot of stuff's changed. I mean, if you're listening to the show and you've got more than $50,000 in mutual funds, you really need to have a conversation and come in. We'll have a cup of coffee and I will show you why you're paying 1% to 2% more in fees than you ought to be paying, just because tools have changed. And that doesn't mean go make wholesale changes to your portfolio. That's not what I'm advocating. But there's no reason to pay fees and expenses that don't belong. You just need to get them in control, and then look for that tax opportunity. We see people a lot who have money that's sitting in a brokerage account and that qualified for a Roth, but didn't put the money in the Roth. Right. And so we automatically move that over. When we do the family update, it's kind of like, hey, let's take $5,000 or $6,500, whichever one you qualify for, and move it over to this Roth account. And people go, well, Joe, it's a headache. Well, it's not a headache. We do all the work.
Yeah.
Right? I mean, there's no reason not to have that money put in the right direction. The fourth area then is life happens. It's the good and the bad and ugly of life that you're probably only going to have to deal with once. And in one particular very sad case that I'm dealing with right now, the father passed away, or the mother passed away. The daughter went to the attorney, and in my opinion, didn't get necessarily the best advice and guidance. Got the best bill, but she had no experience with dealing with the loss of a parent. You're only going to do that, once in your life, really.
Yeah.
And because the mom took care of it when the dad died. It was 25 years ago. So it's things are out there that just change. But it's the good and the bad and the ugly. And last but not least is the legacy plan. So when people come in and they show us their trust, I'm not an attorney, don't play one, don't want to be one. I can tell you that I've got a lot of very well-to-do people in my life that I've read all of their documents. So it's easy for me to find a good clause that somebody may have added to a trust to take care of this situation or that situation, from a bunch of different attorneys in a bunch of different states. And I can make a recommendation that you should go back and see your attorney, perhaps, to add a particular clause
this or that,
to do a certain thing. And it just it helps to have a good memory. But I'm passionate about the estate planning side. I really do not like what happens to families, when people pass away, and I want to do whatever I can to help protect them. So even though I didn't spend my time, because I didn't spend the focus on those 5 areas that I just gave you, my clients didn't. And as we go back and we do it now, it's made a really big difference in helping people in their lives. Your focus is, unless you're really into this though, is limited by the person that you're you're dealing with. And so you really have to ask their model, what their mantra is. And I wonder all the time when I talk to you guys that come in, why you're working with an advisor who doesn't look at your tax return. Because if you don't understand how the 1040 and the brokerage statements are linked together, you won't be getting all of the maximized opportunities that you can. There's nothing that's going to separate you from retirement like the IRS. You send them $1, they don't send it back. Markets go up and down. So I'd love to spend time and talk with you about the Brexit, what it means, what you could have done, what you should have done, what we did. I'd love to have those conversations. But generally where I can help people the most is looking at the 1040, trying to figure out what their objective is for their life after work, for your life after work, and connecting the two in a retirement plan that just makes sense. So just because you don't know it doesn't mean it won't hurt you. Hey, you've been listening to Consider This. I'm Joe Clark along with Sherry Contos. You got a question or comment, shoot me an email. Consider this at yourlifeafterwork.com. I got to take a break. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. Hope the world is treating you well and you're enjoying this wonderful July.
Can't believe it.
Yeah, we do a lot of we're registered investment advisors at the Financial Enhancement Group, and we get asked a lot of questions like, what's your succession plan? Mm-hmm. We have to have one filed by law. It's part of the requirement of having an SEC affiliate with an RIA. We've got more than 100 million, so we have to have it. So we have these normal conversations. But one of the biggest ones that RIAs worry about and that ought to concern you is cybersecurity. The numbers last year show that more than 20% of the firms had an incident where somebody tried to get somebody else's money. Lord knows we have it happen monthly.
Wow.
And I've said forever, there's no way I'm going to have the attorneys that a huge healthcare company in Indianapolis had, or the stuff I don't have the resources to be able to put stuff in play that big. And if they lost your data, then anybody can lose your data. What I can tell you is that ours is based on knowing our clients. So when we know people's life story, what's going on, who they are. If somebody calls in and wants to get money, you're talking to somebody who knows you face to face, not somebody who's playing, who can ask you questions that more than your social security number and your birthday. They know about your family. They know about everything because of all of the planning we do that's in the system.
Yeah.
And then we're able to verbally confirm it. Then it goes through one other source to get it confirmed.
Wow.
I can't control the mean, crazy people that are on the internet. What I can control is a process that we have here to make sure that our families that we take care of are protected and are not one of those 20% of the people that have had the issue over the last 18 months. Couldn't believe it was that big, actually. Hey, you got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com. Thanks for joining us. Have a great week, my friends.
Yep.
And don't forget to go to the website, yourlifeafterwork.com.
Thanks for listening to Consider This with Big Joe Clark. Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group, LLC, is based at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com.